I am fond of saying I don't own gold because I think it might go from 2,000 to 2,200. I own gold because it might go to 6,000 or 7,000 or 8,000. I remember well the period 2000 to 2010. Gold at the beginning of that epoch had been written off completely. It was selling for 250, 260 bucks an ounce. By the end of the decade, it was selling at what, $1,850 an ounce?
RickRule, the founder of Rule Investment Media, projects a bullish outlook for gold, envisioning the possibility of the precious metal reaching heights of $6,000, $7,000, or even $8,000. However, recent market fluctuations have added an air of uncertainty. On Tuesday, gold prices experienced a modest uptick after touching a 3-week low, with February gold closing at $1,996.40, up $3.20. The market appeared subdued as traders awaited crucial U.S. economic data and closely monitored central bank policy meetings for insights into future monetary policy. Rule refers to the years between 2000 and 2010, emphasizing gold's remarkable journey from being dismissed at $250 to $260 per ounce in 2000 to soaring to $1,850 per ounce by the decade's end. During this period, gold, once at its lowest point since 1990, witnessed a significant turnaround, with the economic crisis 2008 further propelling its value as a coveted investment. Gold exhibited an upward trend for several years, culminating in all-time highs of nearly $2,000 per ounce in 2011. Rule remains optimistic about the potential for a substantial surge in demand for precious metals, particularly gold, underlining the metal's historical resilience and attractiveness. Adding to the narrative, the World Gold Council estimated that central bank demand contributed significantly to gold's performance in 2023, enhancing its value by 10% or more. Looking ahead to 2024, the WGC anticipates continued above-trend buying, providing an additional boost to gold prices, although perhaps not reaching the same heights as the previous year. Before diving into RickRule's insightful interview, subscribe to our channel and give this video a big thumbs up.
In the face of what I see as society being between the rock of higher nominal interest rates and a liquidity crisis, that the market share of gold and precious metals related assets is less than 0.5%, which is to say 0.5% of all the savings and investment assets in the United States are in precious metals or precious metals oriented assets. The 4-decade mean, according to JP Morgan Chase, is 2%.
I believe in 1980 it was above 5%, wasn't it?
JP Morgan didn't have access to the statistics, but they estimated that it was between 5 and 6%. But let's throw that out as an outlier just for fun, because we don't need it for our argument.
Okay.
If precious metals reverted to mean, demand for them would quadruple. And that's precisely what I think is going to happen. I just need to say that most Americans need to own more of it rather than less. And the consequence of that is that a price target is higher. I don't think that investors, unless they're extremely knowledgeable and extremely hardworking, should be over-invested in precious metals. Because the truth is, it's an insurance policy where a small premium buys a fairly large payoff. A circumstance where 10% of your net worth is in precious metals and precious metals related assets. If past is prologue with regards to the price performance of these assets during tough economic times, the performance of this 10% of your portfolio in precious metals will offset, if not eliminate, the deterioration that you would see in a whole host of other asset classes. And that's the argument that I'm trying to make here. If you consider physical gold itself as an insurance class and other precious metals related assets like high quality gold stocks as investments, the performance that you get out of this sector means that a fairly small proportion of your portfolio fulfills the insurance function that gold has filled for investors for 2,000 years. And that's what I'm advocating. I think that you need to maintain liquidity in your accounts in addition to having gold. Although, as you point out, gold is superb as a form of liquidity. It's a volatile form of liquidity. And for it to be liquidity, you have to be willing to sell it to buy a different asset class when everything else collapses.
Or borrow against it.
Yeah, or borrow against it
Right.
from me, hopefully.
Yeah.
But I want to return to the fact that it doesn't take a lot of gold. It just takes some gold to provide insurance that you're talking about. And most people don't get that. Or if they do get it, most people confuse themselves with the form that they buy gold in. As an example, although I made the money that I now invest by speculating in exploration stocks, owning a gold exploration stock is not the same as owning gold. The gold exploration stocks are looking for gold. They don't have any. Precisely the point is that you begin your gold investing journey, the gold portion of your portfolio, by owning gold, by owning the stuff. By all means, then, once you've covered the insurance part, invest. Buy the good gold stocks. And if you're willing to work hard and take risks, and if the rest of your portfolio is covered off prudently, then by all means, speculate. Just don't confuse the three activities: insurance, investment, and speculation. That's what I'm hoping to impart to your listeners.
In a recent report from the Labor Department, the Consumer Price Index, a key measure of inflation, showed a marginal increase of 0.1% in November. Notably, it revealed a year-over-year rise of 3.1%, defying economists' expectations of no gain and a yearly rate of 3.1%, as per a Dow Jones survey. RickRule shares skepticism about the CPI's credibility as a true inflation gauge. RickRule finds it perplexing that the CPI does not factor in taxes, which they argue constitute the most substantial household expense for many working American families, surpassing shelter, food, energy, and transportation combined. Despite the inflationary concerns raised by the CPI, U.S. consumer spending experienced its most significant increase in 6 months in July, according to a Commerce Department report. Americans demonstrated a heightened propensity to purchase goods and services. However, this surge in spending was accompanied by slowing monthly inflation rates, reinforcing expectations that the Federal Reserve would maintain interest rates unchanged in the coming months. Adding another layer to the economic narrative, RickRule asserts that their calculations indicate a substantial decline in the purchasing power of savings, attributing a compounded annual decline of approximately 7% to taxes. Let's get back to the interview.
Is that I don't, and I don't think you do, believe that the CPI is really a measure of inflation.
I coined the term the CP lie.
You're right up there
it's
with
in
Jim
my
Grant.
first book.
Yeah, you're right up there with Jim Grant. I mean, listen, first of all, it's hedonistically adjusted, right? Which means that a bunch of big thinkers tell you what your computer's actually worth, which is different than what you paid for it. And they tell you what your house is worth, which is different than what you paid for it. Then, of course, when it's inconvenient, they don't include food or fuel.
Yeah. A car costs less than it did back in the 80s.
Yes. Yes. Anybody who looks at me knows I like to eat. So an index which doesn't cover food and fuel is, from my point of view, strange. But the strangest thing of all, to me, is that the CPI doesn't include tax. The largest household expense for most American working families is tax, greater than shelter, greater than food, greater than energy, and greater than transportation combined. So the idea that a measure of the purchasing power of the dollar doesn't include tax,
Wow.
It's 40% of the household expense of so-called middle-class households. That's pretty crazy. So if you take that as a preamble, I did some probably inaccurate calculations about the deterioration of the purchasing power of my own savings against the basket of goods and services that I consume, mostly tax. And what I believe is that the purchasing power of my savings is declining at about 7% compounded, fully loaded. Jim
Well-
Williams' shadow stats, of course, would come with a higher number, but I don't need to use a higher number to make the point. So let's get back to the arithmetic. The U.S. 10-year Treasury pays you, what, 4.3, I think, currently, in a currency where the purchasing power is declining at 7% compounded. That's pretty ugly math. What the government is saying is that they're going to take away 2.6% of your purchasing power a year for 10 years, a promise which I'm certain that they'll keep. But that sort of bothers me. I mean, it bothers me personally, but the truth is, I've been lucky. I've worked hard. I don't have much to worry about in my life. It bothers me a lot more for younger people. It bothers me for people who don't at least understand, Mike, the nature of what's happening to them. I think it's bad economics, but I also think it's immoral. And I love the chance that you give me to talk about it. And they respond to narratives well. And I don't think that they're so good at arithmetic. I think the voters are probably fairly bad about thinking. Now, they can be excused for this in the sense that it's much more fun and it's much easier to feel and much more difficult to think. When the voters think about inflation, if they do think about inflation, first of all, they think about the CPI, which, as you suggest, is a lie.
Uh-huh.
The second thing about inflation is that, oddly, it benefits the rich more than anybody else. A period of low interest rates, like we went through, lower interest rates, which we went through for 40 years, and high, at least replacement cost inflation, benefited old, fat, bald, rich guys like me. I had access to credit. I had the education to understand how to apply the credit. I bought real assets, and my cost of capital was below what it would be in a normal set of circumstances. At the same time as the replacement value of the assets I bought, things like almond groves and apartment buildings, increase. Ironically, these government programs, if you're clever enough to dodge them, worked out very well, but not in the way that either the politicians, I think, or the voters.
How do recent market fluctuations and the modest uptick in gold prices impact RickRule's bullish outlook for gold, reaching $6,000, $7,000, or $8,000? Given Rule's skepticism about the consumer price index, how might the recent marginal increase of 0.1% in November and the year-over-year rise of 3.1% influence broader discussions on inflation and economic policy? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.